Good evening, COVIDcast viewers. We are at episode 24. Welcome, welcome, welcome. Wow, today is the 17th of September 2020. What a year it has been. Tonight we do start on a somber note. We would like to express our condolences to our private sector organization of Jamaica president, Mr. Keith Duncan, who today lost his father, Dr. D.K. Duncan, a stalwart in Jamaican politics, a stalwart of this nation. And we just want to express our sympathies and extend our prayers to the entire family, the entire Duncan family, and also to Nevada, who we're grateful who could join us today because Dr. Duncan is actually his stepfather. So Nevada, please accept our condolences and thank you for joining us today.
Thank you very much, Rochelle.
Yeah. I know, Nevada, you are committed to the cause. And
absolutely.
We did have a very vibrant episode last week when we talked about the spiritual laws of money. And this week we're talking about developing an investment plan for life, because we said we had to have the part 2. We talked about the savings. We talked about the fact that you can't just be thinking about how much money you earn, but your money needs to be earning for you. So your money needs to be earning while you sleep. Last week, we talked about ensuring that your income is lagging behind your lifestyle and not your lifestyle lagging behind your income.
The other way, you mix it up. Mix it up, Rushy. You mix it up is the other way. Make sure your lifestyle lag your income and not your income lag your lifestyle.
You never see me get poetic, and the same thing we say, and we just say it in a different way. You show them to understand, Nevada. And then, of course, you did touch on some with Toe, when you talk about how much we spend on things and dream about things rather than setting our dreams on how much, on what our financial wealth, which will allow us to be in a better position to realize those dreams. So this week, as again, we're talking about developing an investment plan for life. And some of you may be saying to yourselves, okay, how do I get this information? Because some things happened last week. So if you missed our episode last week, you can just go right back on Facebook and you can find our episode. You can also find us on YouTube. And you can project us on your big screen so you can see it good and hear good. In addition, every week we send out a memo. If you do not yet receive that memo, email us at sme@psoj.org. And remember, please don't just keep this information to yourself. Tell not just one friend, tell all your friends, because we're talking about financial freedom and independence for all of us. It's time that we move out of this thing where every month we just try balance out, we see how the lily money are stretched and we can't see anything gathering in the tilly. Nevada, can you take us back through the spiritual laws? Because I just want us to do a recap of what we talked about last week as we get into
I want to mention one thing though that came up with a number of people who contacted me since last week, Rochelle. And it was one particularly distressing situation where a woman called me and said, after the show, she took to her bed, given the number of mistakes that she made over the course of her life. And it's somebody who just almost becoming 40. And as I spoke to her, I said, do not worry about what you did or didn't do, right? What's the point of that? And that's going to paralyze you from moving forward.
Exactly.
The issue is just begin now, this week, next week, and proceed apace with a plan. Don't worry about a shoulda, woulda, coulda. What does that matter at this point? Do not beat yourself up. Really just focus on how you're going to do this going forward. Just quickly then to go over the 12 spiritual laws. Okay, so money is narrative fiction. Rich enough is a combination of what you have and what you desire. So you can control how wealthy you feel, both by increasing what you have and or by reducing what you want. Because it is the want that trap us into a life of potential poverty. 2, those with an extended financial horizon beyond the now will build greater wealth over time. If somebody says to you, no money down, it means that you're going to have to pay money in the future. You must have an extended financial horizon. Where do you want to be in 5 years? Where do you want to be financially in 10 years, right? And these should not be consumer dreams. These should be asset dreams. How much assets do you wish to have saved 5 years from now, 10 years from now? Money comes to those least interested in the things money can buy. Value people first, then money, then things. Dream as a producer, as an asset invested, not a consumer. You cannot work your way into wealth unless you're Bolt or Kanye West. You can only save and invest your way into it. So earn while you sleep. Passive income is crucial. And understand the issue of inflation, devaluation, and your risk profile, which our guest later will talk a little bit about that as well. Number 5, financial independence and financial integrity is a leading source of mental strength and peace of mind. People who are financially independent can always answer their phone. Those who tend to owe people money sometimes cannot answer their phone and cannot sleep at night, right? So these are part of some of the things about financial independence, the ability to sleep, peace of mind. 6, the wealth of a community begins with understanding good debt and bad debt. We talked last week about the Jews and about the Chinese. And in short order, when they go to new countries, very often they become very wealthy in 2 or 3 generations. Why? Because they are borrowing to start businesses, not borrowing to buy consumer goods which are being devalued. Number 7, respect money and it will respect you. Know your own strengths and weaknesses when it comes to money. Know what you earned last week. Know what you spent last week. Know how much money is in your ATM. Know how much money is in your investment account. Be in control of your money and not hide from it. Socialize across the financial spectrum. Other people's financial lives can give you perspective, right? Hang out with people wealthier than you. Hang out with people less wealthy than you. When you see people less wealthy than you building a good life, it'll give you perspective on your ability to build your own. So it is not a situation where you constantly think, I can't afford to save because I can't live the way I want to live. Lots of people are living well unless than you earn. Get a handle on money shame and be able to say the words, you know what, I can't afford that now. I'm saving for something else. That's not what I'm focused on now, right? Be comfortable with that and do not make up stories that sort of challenge, accept any judgment coming from other people about your financial situation. It's your own. Give, do not lend money to family and friends. This is one of the things that, what I've said, value people first. Lend money that you can afford to lose. So if a cousin or a sister or a brother or a very good friend asks to borrow some money, do the calculation in your mind. If I never get it back, can I live with it? And therefore you will only lend that which you can afford to lose and therefore won't lose friends and family in the process when you're getting upset. 11, those with an emergency hanker down plan before a crisis, which will emerge faster and stronger. You will see COVID is a test of various situations. There are those who had planned for the emergency. Some emergency, they didn't know exactly what it was. There are those who hadn't. Those who already know exactly what they will do. Once a crisis hits, like you lose your job, you can move immediately into execution. If you wait until the crisis hits to execute a plan, to make a plan, you are behind and very often blinded by the emotional stress of the situation. So whatever it is, sit down now and say, if I lose my job, if my wife or husband lose their job, this is exactly what we would do, and know that step by step. And the last one is cultivate a true interest in money matters. Do not say you don't have time. I need you to look at how much time you're spending on social media, how much time you're watching Netflix, and ask yourself, are you in fact spending time on something that is important to you, i.e. earning money for the future? Most of us have time and we just tend not to. So what does that mean? Read about money. Go and see a financial advisor. Talk to friends who are earning money. Read up on various things that you can do. We will hear a little bit from NCB about the types of investments that you can make. So make sure you become smart. Do not say, boy, I'm too tired at the end of the day, I don't have time.
Yes.
You have, and money is a crucially important part of how to build a robust and effective life.
Yeah. And Nevada, as you mentioned earlier, that many of us beat ourselves up and talk about the mistakes of the past. The mistake is getting the information and still doing nothing about it. So start now. And with money shame, there's a song, a very popular song, "For Shut Your Mouth with a Little Bit of Money." And what I say is, if you lick a bit of money and grow, open up your mouth and talk loud. All right. So, Nevada, last week we talked about compounding, and a couple of our viewers wanted to understand this whole concept of compounding. How does it work? Can you take us through compounding?
Yes, absolutely. Okay, the power of compounding. The earlier you start investing, right? What happens over time is that when you put money away for 1 year, at the end of 1 year, your money that you put away will earn some money based on the return. The following year, so by year 2, that interest or return that you had is now going to earn interest for you for the second year, and then interest for the third year. That is what we mean by the interest is going to compound, because the money that you earn is now also going to earn you money. So it matters to start now and not wait. If you put away $1,000 a week, that's $52,000 a year. And then you're 10% a year on that money. By year 10, you're sitting on $829,000, right? This is a massive amount for just putting away $1,000 a week and being incredibly disciplined about it. If you can do a little more, so if you can put away $2,500 a week and have $130,000 a year, earning again the 10% per year, by year 10, you're sitting on $2.1 million. So what is just a small sacrifice in some situations, right? And you keep doing it and you're consistent with it. Over time, you're going to be sitting on a net worth that is going to make you very, very happy, especially if you make sure you put it away and save it and start investing before you spend. So this becomes a crucial part of the idea of compounding, is to recognize that the earlier you start and the more you put away, the better off you're going to be in 5 years, and you're going to be in an incredible place in 10 years.
I'm glad though that you used the example of $1,000. That if you even put away $1,000 per week, you're in a better position than not doing anything. And sometimes some of us are looking to put away a big amount. We don't have the big amount to put aside something. Exactly. So we don't, and we penny off past anything else. So, Nevada, you also last week you had gone through some examples of different scenarios, and I know a couple of our viewers were like, $7 million income, them are earn only of money though. That is very good for them. We're not earning that kind of money. So I know you did a little rejigging of the scenarios, so that we would have a reasonable amount.
But here's what I want everyone to realize before I go through it, because it's correct to do the thing. But understand, Jamaica as a culture is not a saving society. So everybody who's earning 2 million think that the people at 7 million, they're saving. And everybody who earning 7 million think the people who are at 12 million, they're saving. And what I'm here to tell you is at every level, we are not saving. We are not putting money away. Everybody's simply escalating their lifestyle as soon as their income goes up. In fact, we're escalating our lifestyle ahead of our income. So I'm going to give an example again at a lower amount, but understand the key thing I'm trying to get you to learn, everybody to learn, is about the self-discipline of putting the thing away and then investing. And because the trap of spending more than you earn can happen at any level. Slide. Okay. So everybody in this situation is earning $2 million a year, which is approximately $165,000 a month. And you put away, the first one, Jeanette, she puts away 20% a year for $400,000 or $33,000 a month. And her investments earn 10% per annum. In 5 years, if she's consistent, her net worth is $2.4 million. And in 10 years is 6.4 million. That means in 5 years, she has the ability to not work for a year, right? She has more than her salary. And in 10 years, she's very comfortable. And obviously, she can make all kinds of decisions there, financial independence. Late to the money game, Jason, he earns $2 million a year, exactly like Jeanette, $165 a month. But for 5 years, he doesn't actually save. At the end of year 5, he starts to put away 20%, $400,000 a year. And his investment, once he starts investing, earns 10% a year for the afterwards. So at the end of year 5, he has no net worth, no savings. At the end of year 10, however, he now has 2.4 million. Again, the difference between starting early versus waiting is what causes the difference between Jeanette and Jason. Now we have Marva, who's always living above her means. She also earns $2 million a year, but she never has enough funds to cover her expenses. Her lifestyle is exceeding her income. She borrows $400,000 a year at 20% interest on a credit card to support her lifestyle. So in 5 years, she's $3 million negative. And in 10 years, she's $10.3 million negative. And she's not answering her phone. And she cannot sleep at night. And she has stress. And she'll lose her hair. Okay. Then you have somebody who saved and then forgot about it, right? Or also earns $2 million a year, was living at home for a year and saved half his salary. He put $1 million away, which earned 10% per annum. But in year 2, he moved out and just basically lived his salary. So nothing beyond that. For him, in year 5, 1.6 million. He was able to get something quite good. And then in year 10, 2.6 million. So he had a good start, but because he ends up in an okay place. But if he had actually been putting money on top of that, he would have been even in a more impressive place. Yeah. So the key thing I want everybody to take away, especially as we go into the conversation with Renee Barnett from NCB, right? Start now. It matters that you can start now. 2, try and put away as big as you can and do it before you spend. Save before you spend. And 3rd is understand the significance and importance of compounding, which is interest on interest, return on return. And there's several, by the way, what I call compounding calculators online, Money Chimp and all kinds of things. But just Google compounding calculators and play with yourself. Play with different numbers. Play and see what are at various levels of money put away, turning at different interest rates. See how you can be and learn to imagine yourself with wealth, not the consumer dreams. I'm very excited about the conversation tonight with Renee because it's the next part, right? We talked about putting away the 30%, the 20%, the 30%. Now that you're putting it away, what should you do with it?
And that's the question that many people ask. When I put it away, what do I do with it? Thanks a lot, Nevada. We're actually going to be joined now by Renee Barnett, who is a compliance liaison officer at NCB Capital Markets. She has several years experience in the financial services industry. She holds an MSc in Enterprise Risk Management with distinction from the Mona School of Business and Management. And she started her career in the financial industry in marketing and has actually segued very nicely into internal control, risk management, and compliance. And she is very well placed to talk to us today about investments and where to invest. Welcome, Renee. You're on mute.
My bad. I was just saying thank you for having me. I'm so excited to be here today.
We're glad to have you. So I know our viewers are looking and saying, who is this little girl? Renee is in fact a millennial. And so I tell Nevada, we get the old man perspective from him. We're actually talking to a young person today, but someone who is very experienced in the financial industry and in investments. And we want to show that across age groups, we can have the knowledge of the industry, understanding how our money will work for us. It's not for some of us, it's for all of us. And we have not been taught that. We have not been encouraged to do that through our lives. We've been encouraged into consumer behavior. Buy the car, buy the shoes, buy the this, buy the that. Now we're saying, how are we going to grow wealth for us and into the next generation? I remember that we're living longer. So after we retire, we want to make sure we still have some money that we can live. So we're going to be talking to Renee about all of this. So Renee, let me just start with, last week we talked about putting aside 15 to 30% of monies earned. So we know some people are like, when we don't pay my bill, then there is no 15 to 30%. But we are strongly encouraging putting aside 15 to 30%. And you would have seen earlier where we showed at least put away something. So the big question people say, okay, so say I put aside 15%. When I'm trying to come up with that investment plan for my life, I don't know. I take out the 15% and I write a check and I put it down, or I take out the cash and I put it down. How I come up with the investment plan? Help us.
Okay, so I first want to just start off by saying there is no one size fits all to invest in, right? So your investment strategy should be very unique to your personal circumstances. But there are a couple of things that you want to consider before going in. So, before going in, you want to think about, well, what is the goals that you have for your investment portfolio, right? What kind of time horizon do you have to work with? Do you have a long investment time horizon, or is it shorter? And how much risk are you willing to take? So how much fluctuation in your portfolio are you going to be able to withstand? Those are things you want to think about, before you go ahead and start.
Before you go ahead. So you're thinking about, what are my goals? So I may say that I want to have $2 million in 5 years. I want to have investments of 2 million. Okay, so that's a goal. A time horizon is saying I want the 2 million in, say, 5 years. So that's a time horizon, because we really do need to give it our thought about it. We have to think about what we want. And when you talk about the risk now, we have to say, like, what kind of risk I can manage with my money,
Yes.
So that now looks at the type of investments that I will enter into. Okay.
Correct.
For that. So, Renee, most of us start with, when we start work, and so we get a savings account. And most of the time we get it just so that the pay can go in there. Now, after we've started with that savings account, when are we supposed to be graduating from the savings account?
So I don't like to think of it in terms of graduating, right? We don't need to graduate from a savings account. We need to just start now. As Nevada said, just start now with whatever you have. So one of the best lessons that I learned from reading the book Rich Dad, Poor Dad, and I would recommend everyone go ahead and read that book because it's a gem. But one of the best lessons was pay yourself first. So when you get your paycheck, take that 15 to 30% that Nevada spoke about and pay yourself before you pay any of your bills. You want to take a portion of that 15 to 30% and make sure you want to have an emergency fund, of course, because, life happens, things come up. But you also want to make sure you take a portion of that and invest it. So don't wait to graduate from the savings account. Start with what you have now.
Okay, so we have the savings account. We have our pay going into the savings account, and we're going to start a process now where we are paying ourselves first. And we say to ourselves, all right, I'm going to take out 15% of my earnings. Before I pay anything else, I'm going to take 15% out. Now, in terms of investment and how I divvy up that 15%, can you take us through what are some of the considerations and what are some of the investment types that we could use and put that 15% to?
All right, so there are lots of different investment types, and I'll take you through them. But before I go ahead and go through them, I want to also put it out there that don't think of it in terms of all right, well, I like how stocks sound, so I'll buy some stocks, or I like how bonds sound, so I'll buy some bonds. You want to make sure that you have a diverse portfolio, and it's really your asset allocation is tailored towards your risk profile, and we'll talk about that a little bit later. But I'm just saying, don't just think about one type of asset. But yeah, so there's various asset types. You have stocks. So a stock is pretty much ownership in a portion of a company, right?
So that's also shares. When you buy shares,
right? So buying a stock is buying a share. It's the same thing, right? And you're buying ownership into the company. And when you buy a stock, there's two ways that you can make money from it. You can make money through dividend payments, or you can make money through capital gains. And the dividend payments, what that really means is that when the company makes a profit, if it's a dividend paying stock, the company will pay its shareholders, which would be you owning a piece of the company. The company will pay its shareholders a portion of that profit. So for every share you own, you'll get a predetermined amount per unit. And the companies typically pay dividends on a quarterly basis. So that's income that you're getting from having stocks. You can also make money from the capital gains, as I had mentioned. And really the principle behind stocks is you want to make sure that you're buying low and you're selling high. And I'll give you a personal example. So when I first bought shares in Supreme Ventures, I think back in 2017, it was trading for about $5. Pre-COVID, Supreme Ventures was trading for, I think, $25 back in 2019, right? So you're talking about buying 1 unit of Supreme Ventures for $5 Jamaican, and then a couple years later, it's worth $25. So if you had put in $100,000 into Supreme Ventures, your 100,000 would have appreciated to 500,000, right? So you make 400,000 on that 100,000, right? So that's capital gains, and those are the two ways that you can make money from stocks. Okay. So then you have bonds, which is a fixed income instrument. So basically, with a bond, you're lending either a corporate entity or a government entity. You're lending them money for a specified period of time, and then they're going to pay you either a variable interest or a fixed interest rate. And this is a legally binding agreement that you're entering with the entity, right? And so the bonds typically pay you interest either they typically pay interest on a semi-annual basis, right? And so the good thing with bonds is they're a little bit less risky than equities because they're a little bit less volatile. And so they're really good for capital preservation and then income generation because you're earning income on the interest that the bond is paying you, right? And as I said, it's a little bit less risky than an equity.
That's a longer term investment also.
Right. Bonds are also longer term investments than equities. So if you're a conservative investor, you probably have a bit more exposure to fixed income instruments than equities. Right. So
we've gone through stocks, which are shares or equity. We've gone through bonds, and stocks are a riskier investment, but you can also get substantial gain from it. I love to get my dividend, check them, and I put them all together and I save them in a particular investment instrument. So they grow for me and they continue growing for themselves while I sleep. And then you have the bonds, which are for the more risk-averse investor with a guaranteed interest rate, usually payable semi-annually, but usually for a longer period of time. Now, there's another thing that we'll hear about when we go to investment houses, and we hear about mutual funds. Tell me about these mutual funds.
All right, so a mutual fund is pretty much a structured pool of assets. So it's almost like a basket of assets. And mutual funds are great because one, they're managed by an investment manager. So you don't have to worry about, should I buy this? Should I sell that? At what point in time should I buy and I sell? But it also gives you instant diversification. So you're buying a pool of assets. If there's a negative event that impacts, one security or even one industry, your portfolio is not going to be too much affected because you also have dozens of other securities within the portfolio. So mutual funds is a great investment vehicle for instant diversification. And also you don't have to manage it yourself. You don't have to worry about it.
Okay. And that's more for, you say what, the moderate persons with a moderate risk appetite?
I would say persons with a conservative risk appetite, but there are, some mutual fund portfolios that might have different risk appetites attached to them, right?
Oh, all right. So as our viewers are listening, they're saying, I hear you, Renee, you work at NCB Capital Markets, so you understand all of these nice things. Now, when I go to an investment house, say like a NCB Capital Markets, now I want to understand as an investor, as a fledgling investor, what are some of the questions I may want to ask before I decide which instrument I use?
So the questions you want to ask, I think you really want to understand your risk profile before you decide what investment you'd like to invest in, because your risk appetite is really going to guide your asset allocation. So if you're someone who is more of a conservative investor, your portfolio might look something like having only maybe a 10 to 30% exposure to equities, and then a 70 to 90% exposure to fixed income instruments, again, because they carry less risk, generally speaking, than equities. And if you're more aggressive now, your portfolio is probably going to look like having 70 to 90% of your portfolio in equities, and then the 10 to 30% in fixed instruments or cash.
Okay, so the risk profile, though, I know what my risk profile is, or are you going to help me with that? How I know what my risk profile is?
No, so when you go to your broker, they're going to do a comprehensive assessment of your risk profile, right? Every broker should do an assessment of your risk profile. You're not going to know it offhand. It really takes into consideration a host of factors and looks at your situation, holistically.
Yes. And I think that's a very important thing for people to understand, because sometimes we think that we need to make all of these decisions without advice, and the advice is available.
Important.
So I've got my risk profile and so on. I've decided the mix of investment that I'm going to do. And I know another key thing that we have to consider is this whole concept of the effect that inflation and devaluation will have. Now, we're bringing this up too, because one of the things we say is that we're not just talking for financial independence. A big part of it is improving your financial literacy. So you are understanding, one, how much you have, how much it can earn, and the different risks associated with it. There's nothing wrong with it, and it's not above any of our heads. So Renee is just going to simplify for us how we protect our investments against inflation and devaluation.
Okay, so when inflation increases, of course, the prices of goods and services increase. And if your investment is not increasing at a higher rate of return, then really you're not making any real returns on your investments. Typically, companies' revenues move at the same pace as inflation, so you don't have to worry about your stocks too much when it comes to inflation. However, if you have some exposure to bonds, that's where you might be a little bit concerned. So, for example, if you have a bond that's paying you $1,000 every year, $1,000 every year. So that $1,000 now might be a great return for you now. But if you think about it 10 years down the line, and as you had mentioned, bonds is a long-term instrument. So if you think about it 10 years down the line and you're thinking, okay, well, is this $1,000 going to do the same thing for me in 10 years that it's doing for me now? Well, probably not, because of, you know, inflation, as you had said. But the good thing is that there are assets that will help to protect you against inflation. So there's treasury inflation protected securities, and pretty much what that is a special type of bond where the principal and the coupon payments will move at the same pace as inflation. So if you have bonds in your portfolio, you might want to, you know, speak to your advisor. Is this going to move at the same pace as inflation? You know, ask those types of questions. But also real estate. So real estate is also a good investment in terms of protecting against inflation. Typically, the real estate prices increase year over year. So that's something that you can consider if you're able to add to your portfolio.
Okay. And it's the same kind of consideration with the valuation, that you want to take the valuation into your consideration. Did I say consideration like 12 times? Or do you treat with the valuation?
So for the valuation, I would say, you know, make sure that you have some exposure to some hard currency denominated assets in your portfolio. So you don't only invest in JMD denominated assets. You know, have some exposure to some US assets in your portfolio. You know, maybe you might want to buy a US denominated bond. You can buy a US dollar mutual fund. Have some hard currency exposure in your portfolio.
Okay. Another question. Insurance as an investment vehicle. Let's talk a little about that.
Okay. So insurance is definitely a good investment that you'd want to consider as a part of your portfolio. There's generally two categories of life insurance. You know, you have term insurance and you have permanent insurance. And so term insurance is, it covers you for a specified period of time and is basically designed solely for, you know, your dependents if you die, right? And then you have permanent insurance, which basically covers your entire life period. And while it does also have a death benefit, there is also an investment component to this type of insurance as well, right? So there's a cash value that's added on this type of insurance, and there are many benefits to having, you know, a permanent insurance, so that the cash value will accumulate over time. And you don't necessarily need to wait until, well, I don't want to say wait until you die, but
you're able to draw from that.
You're able to surrender the policy before and get the accumulated savings before. So you can use this as a part of your retirement nest egg, right? Yeah. And the great thing about the cash value also with permanent insurance is that it grows on a tax deferred basis. So what this means is that while your gains are accumulated, you're not being charged any taxes on this. Okay. So definitely it's something that you should consider as well.
Yeah. And I know sometimes when the insurance brokers have gotten our names from somebody and they're calling us, we're like, what am I bother with that? What am I bother with?
Yes.
Answer the phone, because this is another means of investment. So you get the double whammy of the insurance, but a savings portion of it that is not subject to tax. Hello. So if you are just joining us today, we're talking about developing an investment plan for life. So we started with a recap of last week's show. Last week, we talked about the spiritual laws of money, and the big question that comes in now that I want to start saving, where should I be putting my money and how do I develop that investment plan? And we are joined today by Renee Barnett of NCB Capital Markets. She's taken us through some investment vehicles, and we've talked about risk profile, and you're wondering, how am I going to get to see what I missed? You can, the entire show is going to be available on Facebook right after this, and we're also available on YouTube. So please, you can still catch up. So Renee, this concept of a balanced portfolio, you know, we love to talk about balance in life. Now tell me about balanced portfolio.
Sorry, hold on. Gosh.
We're hearing you though.
Okay. Okay. So a balanced portfolio, and this again goes back to your risk profile. So you want to make sure that your asset allocation matches your risk profile. And what this means is that if you're a conservative investor, you don't want to have your portfolio too heavily weighted in something that is more aggressive, right? You want to make sure that your investments are very conservative. So going back to the same, 10% in equities and having 70 to 90% in fixed instruments or cash. That's really what the balanced portfolio is about. Yes. Ensuring that it matches your risk profile.
Yeah. Okay, so we've talked about looking at our risk profile. We talked about the balanced portfolio. Now there's this whole toss up that people are, do I do financial investment or real estate investment? How do I do that trade-off and determine which is best for me?
So I love this question. I find that people are always very attracted to real estate investment, and I guess because it's a tangible asset and you can control it.
Yes.
So whereas when you're investing in a company, you literally have no control over that company, but with real estate you can control it, and it's a little bit easier to understand as well. But the reality of the situation is that investing in real estate really requires a lot more initial capital than investing in the financial market. So I would say that getting into the financial market is a good gateway into real estate investing. Yes. And you're still able to get some exposure to the real estate market through the stock market as well, because you can purchase shares in a company that does real estate investing. Last year, I think it was last year, Epley would have listed on the stock market, and one of Epley's core business lines is investing in real estate. So you can still get exposure to real estate through the stock market if you don't have, the huge initial capital to get into real estate. The stock market, the financial market is a great gateway.
Yes. And the thing too is that from your gains from those financial investments, you actually will have cash for the real estate investment.
Right.
Yeah. So, question. Say we have a viewer. And we have one viewer who is married with children. Okay. Now having to do homeschooling. So there are a whole heap of things on their mind. Right. I have another viewer who is single without kids. Are the investment considerations different when you're married with kids, or not married but with kids, or you're single, no kids? How different are your investment decisions?
All right. So I would say, again, we have to think about things holistically. So I could be a single parent, and I could be the sole breadwinner of my family, and I have to take care of my spouse, my kids, my parents. I have to take care of everybody, right? My risk tolerance might be lower than someone who is single with no kids, because I have more dependence, maybe I have less cash, that sort of thing. But it's not just about just about one single.
The labeling, yes. Yeah.
Right.
Yeah, and I think that's very important, because I think sometimes because of the labels, we think that each label has a set of considerations. It's a holistic consideration. I see Romeo Stewart saying here, I like tangible assets. Francois Brown said, always great to diversify. And people were quite pleased with the recommendation, Rich Dad, Poor Dad. And also just to point out, again, if you have not yet signed up for our weekly memo, please email us at sme@psoj.org. And the memos actually come with a set of links to articles, all manner of references, things that simplify your decisions from the discussions that we had last week, we also have a set of links this week. So you have a lot of material. So what we're going to do this week is we're going to, when we on our devices, we can cut down the Instagram time to do a little reading time too. So we're going to diversify how we use our time. So, Renee, so you are, and let me talk about your business. So Renee is in her 20s. A place I remember a long time ago.
Yeah.
Now, for persons in different age levels, in their 20s, in their 30s, in their 50s, 60s, 70s, are there different investment strategies that need to be employed depending on your age?
So definitely, as you get older, you're going to want to reevaluate your investment strategy. You're going to want to reevaluate your risk profile, because these things will change over time and your circumstances will change over time as well. But what I'll say is that when you're younger, you really have the ability to take on more risk, because your investment time horizon is longer. So you have a longer time to recoup any losses that may have occurred over the years. And generally speaking, the markets trend upwards anyways. So the younger that you are, typically, the more risk that you're able to take on. And so I would implore everyone who is young, to go ahead and start and be a little bit more aggressive. But as you get older and as you get closer to retirement, you're going to want to be a little bit more conservative with your investment approach, because you're going to need to draw on these funds soon. Yeah. So yeah.
Okay. I think I'm seeing here a comment from Omar Irvin. Omar says, "I'm loving this. Renee, you have a buzz. I learned that today. You have a buzz."
Love it.
No, a big topic from last week is so we have generational crisis, in my view, with how we view money, that we just have not been properly educated. Our financial literacy, we think it's for some people. We don't want to talk about it. We don't talk about money. And one of the key things we're doing on this show is we're changing that narrative. So for parents with children, and I like to say for aunties with niece and nephew, uncle with niece and nephew, the godparents. Now, we have a duty to to change the narrative. When do we start talking to children about investing and saving?
So I love this question, because when I look back, nobody spoke to me about investing. I didn't learn about investing until I started working. Okay. So when I was maybe like 10 or 11, I would have gone and opened up a savings account, and, my parents speak to me about make sure you save, but nobody said anything about investing. I think it's important at the same time when you're talking to your children about money and saving, you speak to them about investing as well. Yes. And so I think, go ahead and open up an investment account, add your kids as joint holders, and get them involved in the process. Yes. I remember from when we did the Trans Jamaica IPO earlier this year, one of my coworkers was talking to me, and she was saying, oh, her son is so excited to get on the Trans Jamaica IPO, and he saved $5,000 and he's putting it in there, and he just bought some NCB last week and he's excited. And her son is in like high school. So I'm saying to myself, when I was in high school, I was talking about, I want this new cell phone and I want these clothes. I was not thinking about investing or buying stocks. I didn't even know what that was. So I think, the earlier that we start talking to our children about this and involving them in the process, we're also going to be helping to build a nation of investors and not just consumers, as Nevada had mentioned.
Yes. And what you talked about is that we do have a consumerism culture. So even when we're thinking of how we gift children, we think about things, that we give them things, clothes, boot, toys. that, you know, sometimes you give them the toy and they play with the plastic bag of the toy, and we are less likely to open an investment account or to buy some shares for them. But you know, if we start that conversation from early, we're changing the mindset, and we are ensuring that the mindset is a mindset of an investor, of growing wealth, of not just making wealth but knowing how to keep it. And this is how we change our nation. So we have a poll, Renee. The question we asked is, do you currently have an investment account? And 72% of our viewers said yes. Congratulations. 28% of our viewers said no. Congratulations too, because now you have the information, so I know tomorrow you're going to do something about it. Jana Patterson just says financial literacy should definitely be a mandatory course in high school. I think ninth grade, perfect grade to start the conversation. Thanks for that comment, Jana. So now we have a lot of our viewers who are business people. And the question is, do I invest differently if I have a business or intend to have my own business? Do I invest differently?
And I wouldn't say that you invest differently. What I would say is maybe if you're a small business owner, you might not earn a consistent amount. Your salary might vary month over month. But you might want to look at, okay, well, how much do you earn on an annual basis on average, and really just commit to invest in that portion. But again, you know, you really have to look at things holistically and look at your risk profile. It's not necessarily that you're a business owner, so your investment strategy is going to be different.
It's going to be different. And when an SME is thinking about investing differently, you know, you have your own business, you have to be paying yourself a salary, and you try sometimes, so you know, sometimes some people pay themselves well, some people can't pay themselves. What kind of investment decisions when an SME looks at what they are paid from their own business, they're saying, are they supposed to still have an investment plan? Because I think that's one of the things, we don't have an investment plan as a small business.
I think, of course, everyone should have an investment plan. Are you saying that the business itself, or are we speaking about the individual that owns the business?
Well, I'm glad you asked. I'm glad you flipped the question that way, because that is in fact a two-part consideration: the person in their individual status and also investment for the business.
You definitely want to have investments for your business, but I think that could probably be a whole nother discussion.
So for the individual, you really should still have an investment plan.
Absolutely, absolutely.
And one of the key themes from what Renee is saying is, let's forget the labeling of whether you're married, you're single, have kids, no kids. That we still have to look at what our current situation is and judge it on its own, and what's available for us, what's our risk profile, what kind of risk can we manage, looking across the different type of instruments. We have shares, we have mutual funds, we have bonds. There's also, very importantly, insurance, which is one of the simplest forms and gives you the double whammy. Now, before I go any further, Karen says, is sending my child to university an investment? Karen, I love that question.
Okay. Well, I guess it would depend on that child. But it's definitely an investment for the child, though. Absolutely.
Yeah. So it is an investment for the child. And Karen, I mean, investing in our children's education is actually a very important way for ensuring too that they are in a position to have financial independence, because they are able to establish a lifestyle. So that start we give them is very, very important. I remember a financial advisor once said to me that we always have to be careful that children are not our pension. So in investing in them, we still have to have an investment plan for ourselves. And what we want to do is to ensure that we're always putting them in a position that they have financial literacy and they are in a position to be financially independent. Now, German Selector J. Rod says, capital payments toward mortgage or invest in stocks.
I invest in stocks. I mean, of course, you want to pay down on your debt, but you don't want to have to choose between just paying off your debt or investing. You still want to invest, right? Debt or no debt, because we're going to. If you think about it, you're going to have debt throughout your life, right? If you want to buy an apartment, that mortgage is going to be 30 years. You can't wait until after that 30 years to start investing that, So, yeah.
Okay. Steph Rose says, what investment instrument yields a consistent 10% return over 10 or more years?
So I would say that's a conversation that you want to have with a financial advisor. Open up an account with a broker if you don't already have one. Speak to your financial advisor and find out more information on what type of security you can get with that return. I mean, that's a high return for a fixed income instrument, but you want to have that discussion with your advisor.
And in addition, sometimes that 10% return is across a portfolio, across different types of investments that you have. So that conversation with your broker is very important. So, Renee, what are some of the biggest mistakes people make when it comes to investing?
So the biggest mistake that they make is that they don't invest. That is the biggest mistake. You don't want to make fear or your lack of knowledge stop you from investing. I think the last time that I had checked it out, we had maybe 200,000 accounts with JC. So that's not a lot, if you're thinking about the population of Jamaica. I'm not sure what the numbers are now because they might have increased with the Trans Jamaica IPO. But yeah, so the biggest mistake, number one, is not starting. Don't make anything stop you from starting. Start now. But another mistake that I would say people make is, not really understanding the investment. So if you're going to be putting your money in something, you're going to be investing in a company, make sure you understand that company. Make sure you understand the business model of the company. Don't just, your friend said, oh, this is a good investment, let me go and put my money in this. Do your research, do your due diligence, make sure you understand what you're putting your money in. And make sure that you have some patience as well. So you have to remember that, investing is not a get rich quick scheme, right? Yeah. Having a slow and steady and disciplined approach is going to get you a lot further than, you thinking that, all right, I'm going to buy this stock now and it's going to flip in a month and I'm going to sell it, right? Give your investment some time to appreciate in value.
Yeah. And one of you had mentioned the book, Rich Dad, Poor Dad. Another very interesting book as you're starting on this journey is The Richest Man in Babylon. And that book actually goes through very nicely how you divvy up your earnings. And it in fact goes through a lot of the spiritual laws of money that Nevada had mentioned last week. Because remember too, as we're building our financial literacy, we're opening up our mind, we're read. Now, a question that I see coming in is the new IPO from Tropical Battery. Any advice? And I know the advice that Renee is going to give is that you are going to want a broker. And you want to get some investment advice. And one of the things too is that our investment banks, all of them, in fact, most of them send out a memo, usually weekly or monthly, talking about the market, what you should buy, hold and sell. And you read them and call and ask questions. And one of the things too is that when you're dealing with your money, you ask any question that you think is a worthy question. There's no question that is a silly question when it comes to your money. So conversations with Colette. Hey, Colette says, start small and gradually increase as your income and or cash flow increase. Great point. Jermaine says, as a private company, how profitable should you be or how long before you go public through an IPO? I don't think I'm going to put that question to Renee because no, we're going to talk about that in another episode, Jermaine, when we're talking about being able to move your company from a private company and preparing it for listing. So I know that you're going to keep tuning in. Nicholas is asking about Renee's personal best stock picks. We can't put Renee on the spot like that. Renee's at NCB Capital Markets. In fact, we have lots of investment banks and we are strongly encouraging you, now that you have this information, that you are in fact heading out tomorrow to make some changes to your life. Renee, thank you so much. As I say, you have a buzz, so you have to leave us with a buzz. What key points do you want to leave our viewers with tonight?
Start investing today. And you know what the good thing is that brokers have made it so easy for you to start now. It definitely wasn't as easy when I would have started. You know, you can open your account online these days. So you really have no excuse to not start, right? Yeah. Open your account with a broker. You don't need to know everything. You'll get a licensed financial advisor. They will guide you along your journey and, you know, make recommendations to you that are tailored towards your risk profile and your unique circumstance. But start today. Start small. Just start.
And can you see that has just been a theme throughout these two programs, because today is actually part 2 of a conversation that started last week. Today we're joined by Renee Barnett of NCB Capital Markets, and she talked to us about developing an investment plan for life. Thank you so much, Renee. It was a pleasure having you. And we know that these tips are going to come in very handy, especially too, because they are in our weekly memo. And again, if you have not yet signed up for the weekly memo, please email us at sme@psoj.org. So we were joined by Renee Barnett of NCB Capital Markets. And I just want to bring back Nevada in for about 3 minutes, because I know he's quite excited backstage about this discussion. So Nevada, we started this conversation last week. We started this week with recapping this 12 spiritual laws. We looked at compounding. We looked at various investment instruments, risk profile, etc., etc.
Yes.
Now, putting this all together, what are some of the key points that you want to leave with the viewers tonight?
So some of the things that that is stopping people is the fear, right? Fear of the language, fear of who do I go to. We have a lot of brokers, a lot of things, and each broker, each bank will have a whole bunch of different products. And what people keep telling me is that they're afraid to start, and even when they go in and they talk to the financial advisor, sometimes a stack of papers too long, and them don't know, them get scared, them leave, and then never go back. So here's the thing, again, not to oversimplify it, but as Renee said, when you're younger, you're willing to take more risk. But the first thing you need to do is to teach yourself to save. So start with a saving account and put the 15 to 30% away and let a little bit grow so you start to have a nest egg. Now, the issue with most savings accounts is that the interest paid on most savings accounts is lower than the inflation and often lower than the devaluation. So some of it you want to actually be saving in US dollars, so you don't have the devaluation problem. And some of it you want to make sure that you're getting enough to save above inflation. Then you move to a simple investment account, and it's good to probably start with some of the index funds, right? So the bond
funds would be
mutual funds. So the bond one, for example, is going to be conservative. If you're feeling pretty conservative, the stock one will have more fluctuation, and then a mixed one will again be somewhere in between. So just start with one of those, and then keep putting the money, and then watch yourself. Because remember, you can change your decisions and so on as you start to get smarter, right? And then now, once you start to be comfortable with the index funds or the mutual funds, then you say, you know what, let me try 1 or 2 individual stocks where you could have wild fluctuations. You make a whole heap of money, but you can also lose money. So you put a very little in that as you start to become a little more savvy. But it's really, really crucial. Do not be afraid. And I also want to say to the financial houses, we as Jamaicans are afraid to come and talk to you. money is money and health are the two scariest things. We need you as financial houses to break down the stuff for us in our language, simple language. If you give us the big farm and I use all of our word, we're not going to come in. It's one of the reasons, it's the languaging that is creating the barrier for a lot of Jamaicans. And I need you guys, everybody who works at a financial service company on the front line, think about your grandmother. Think about your best friend and talk to whoever is in front of you or on the phone in a way that they can understand. And by the way, allow the possibility of them asking questions. So you don't just run it over their head. You say, hey, did you understand? And sometimes we will pretend to understand, we don't understand. So
what do you understand from what I tell you?
Thank you. What did you understand from what I tell you in an open way? It's not quite right. Let me explain again. Let me think of another way to say it. And keep doing that, because you not only will you have first of all, if you do that, you have a customer for life.
Exactly.
Because most people, 99% of the people speaking to the people are intimidating them. So if they find someone who they can lock in a very, very simple way, not only will you have them for life, they will be recommending their friends. And they're going to be piling up to come and see you because they're going to say, you know what? I understand what Rochelle say. And she's guiding me every step of the way. So really, there needs to be additional training in the financial services front line about how to speak to Jamaicans about money.
Yeah, and you know, we encourage too that our financial advisors that are watching this show, that sometimes you have to see a bigger picture, because the role that you're playing is a role of a nation builder. Because what we're doing is creating a nation of investors. And when you see that bigger role, you're approaching this completely different. In fact, we just had a poll with our viewers. What kind of financial assets do you currently invest in? Stocks and bonds, 53%. Mutual funds, 13%. Real estate, 7%. Other, 27%. And you know, so as our viewers, as you rewatch this show, as you go through the memo, some key things that we're saying to you: start. No matter worry about what did happen yesterday and how much money you did spend on some other things. Just start. You have a right to understand how you're investing your money. Ask the question. Anybody that looking at you like saying, shut your mouth with a little bit of money, where you ask so much question, go somewhere else. Ensure too that, as Nevada says, when that money goes into the savings account, at least make some money start going into a savings account. And we're saying 15 to 30% of what you earn. So some of us have to sit down with a piece of paper and really ask ourselves how we're spending our money. And if we look back on the spiritual laws and we start thinking about the things, how thingsy we are, we're realizing that there's so many areas that we can cut down on. Remember, at the base of all of this is that very important law. Do not cause, Nevada, you said me did say it wrong, so you say it to me.
Let your lifestyle lag your income. Do not let your income lag your lifestyle. If you get into that mindset, and additionally extend your financial horizon, where they want to be in 5 years, not just today. If you just lock those two things in, you will start to see the kind of asset growth that will put you in good stead. Financial literacy and financial independence is two crucial things that Jamaica has to learn. And we have to learn as individuals and then as a country. And as you said, the financial service companies have got to recognize that part of their job is nation building. We never learn about money in school unless you come to camp and I take my class. We don't learn about money in school. We learn it on the fly, and most of us never learn it. And therefore, there's a responsibility for us to take the time to proactively seek it on our own, but also for the financial services companies to guide us.
To guide us.
Understanding.
Yes. So viewers, what another great episode of COVIDCASTJA, as we're talking about how we are building wealth, how we're going to come on the other side of COVID, because we're coming out better than we started. So we are at today's episode 24. So you've probably missed 23 episodes if you're joining us for the first time. If you have missed the past 23 episodes, you can find us right here on Facebook. You can watch them all. You can find us on YouTube, and you can put it on your big screen and gather the family around as we are talking about money, as we're discussing investments. Don't watch it by yourself. And we're saying this is now the time that we're moving into a whole other space of changing the narrative for our lives, because we are not just learning how to make money, we are learning how to keep it and how to grow it. So we are here every Thursday at 7:30 p.m. for COVIDCASTJA. Please, if you do not get our weekly memo, I am repeating, email us at sme@psoj.org. We're looking forward to seeing you every single solitary week. What you saying, Nevada?
And Rochelle, one last thing. The memo is also available and the programs on smallbusinessportal.com. So you can actually just smallbusinessportal.com, very easy. Look for COVIDcast. You can watch the show. You can print the memo right from there and read the memo and while you're watching the show, etc. What we're finding is people learn in different ways. Our job is to try and create multiple ways of access, multiple ways of learning. Some of you are visual, some of you are readers, some of you need to sit with something and to go back. So let us know that if we're being helpful. This is what we want to do. We're really on a long-term mission to increase financial literacy and business acumen in Jamaica. Thank you, Rochelle. Fantastic.
So please leave your comments. Don't tell a friend. Tell all of your friends, all of your family, because we're doing this together. And we just like to thank again our special guest, Renee Barnett, Compliance Liaison Officer, NCB Capital Markets, who gave us a buzz tonight. So see you again next week for another episode of COVIDCASTJA.
Excellent.